If you're concerned about interest rates, Trump's policies, and a stock market crash, just wait for the aftermath. Joining me is Jim Rickards to talk about his new book. Hi, Jim. Thank you so much. This is awesome to be here at the New York Stock Exchange.
It is. It's great to be with you, Boz. Thanks.
So, Jim, your new book, Aftermath, is that a sequel to your previous books?
It is. It's actually volume 4 of the International Monetary Quartet. So it's Currency Wars, The Death of Money, The Road to Ruin, and now Aftermath. I may write another book, but I think there's not much more to say on international finance. But yeah, it's volume 4, and any resemblance to the Four Horsemen of the Apocalypse is strictly intentional.
Wow, so it's hard to define who those horsemen are, but you know what? I love how you use metaphors in your books. Previously, you've used an avalanche to describe the market conditions. How did you use Greek mythology in this one?
Well, metaphors, mythology, stories, whatever it is, there are two things. Number one, a lot of economics is full of jargon, and it's actually not that complicated, but the professionals, the PhD economists use jargon to kind of put people off or make it seem like they've got a secret club or et cetera. And as I study it, I find that you can do it in plain English without, it's not dumbed down at all. This is like PhD level stuff. But if you say it in plain English and use a metaphor, people understand it. Well, what's wrong with that? For example, an economist will say, downward nominal wage rigidity. Well, what the heck is that? It just means that people don't like to take a pay cut, and they don't like to take a pay cut. But if you say it, people get it. So I find that, again, the metaphors and just plain English goes a long way.
And how did you use the Odyssey in this book?
Well, the Fed is stuck. I used Scylla and Charybdis. So Charybdis was a whirlpool, daughter of Poseidon, and Scylla was just kind of a monster, would eat you alive. And Odysseus and his crew had to sail between them. And the question is, you got two dangers. And so he said, he faded Charybdis. He said, if we get pulled into that, we're dead. I'll take my chances with Scylla. Even if she eats a couple of the crew, the rest of us will survive. Well, that's the metaphor. That's the mythology. But the Fed has the same problem. The Fed wants to do two things. They want to raise interest rates. Now, I understand they're going to cut them on July 31st. I get that. But they want to raise them. And the reason is, history shows that you have to cut interest rates 4 or 5% to get the U.S. out of a recession. We're not in a recession right now, probably, but the point is, when we get in one, you're going to have to cut interest rates at least 4% to get out. How do you cut interest rates 4% when you're only at 2.25%? The answer is you can't. And the evidence is very good that negative interest rates don't work. That's a separate subject. So they want to get them higher, but the question is, how do you get them higher without causing the recession you're preparing to cure? And the answer is you can't. You can't skirt between these two things. So Jay Powell got the wake-up call last December. The December rate hike was one too many. We had the Christmas Eve massacre. The market had gone down like 11% from October 1st to December 24th. So he comes out and he says, okay, we're going to be patient. Boom. That's the signal that they're not going to raise rates. And the market rallied on that. But now they've gone even further, and it's very clear that they're going to cut rates on July 31st. I would say 25 basis points. If they have a surprise to the markets, it's going to be an early end to QT, that's quantitative tightening, because they had a double tightening going on. They were raising rates, but they were reducing the money supply. So now they're going to cut rates. Okay, but they're still reducing the money supply, which is a form of tightening. It's a contradiction. So they may end QT as well. That would give the market an even bigger boost.
Well, here's a question that no one seems to be able to answer, so let me give you a shot at it. Where's inflation?
Inflation is nowhere to be seen. Actually, the central bank, the Fed, feels that they know how to deal with inflation. We don't have any, by the way, but if it appeared, they think they know how to damp it down. They're scared to death of deflation because they don't know how to get out of deflation. And this was the problem in the Great Depression. I mean, actually, FDR figured out how to get out of deflation by devaluing the dollar against gold. In the greatest deflationary episode in U.S. history, 1929 to 1933, gold went up 75%, from $20 an ounce to $35 an ounce. But that was the government doing it on purpose to get everything else inflated. So central bankers are scared to death of deflation. Now, we all know the Fed has this 2% inflation target under PCE, core year-over-year price deflator, so the arcane metric, but that's what they use. It took them 6 years to get it to actually tick at 2%. And then it went right back down again. Now it's about 1.6%. It's heading in the wrong direction. So this is, it's a sad day when the central bank wants inflation and can't get it. The reason is monetary theory, starting with Milton Friedman, going back to Irving Fisher, They always assume under the Austrian influence that inflation is always a function of money supply. It isn't. That's an incorrect assumption. Inflation is psychological. It's behavioral. If you think your money is going to be worth less, you'll go out and buy a car, buy a refrigerator, buy a new house, whatever it is. But if you think money is going to be worth more, or if you think that deflation is an issue, you'll save money and spend less. Because prices are going to go down. So it's the change in the psychology. Right now people are in a deflationary mindset. And demographically, populations are flatlining. Population of Russia is going down. Population of Japan is going down. Population of China is flatlining. U.S. used to go up a little bit, but when you cut off immigration, most of our growth was from immigration. That's being reduced. So the world wants to deflate. The central bankers can't stand it. So they're trying to inflate by printing money, but they don't understand you have to change psychology. So this is the Scylla and Charybdis, going between two dangers and not knowing which one to choose.
Well, Jim, the Fed gets a lot of blame. Central banks get a lot of blame. But can we also put some blame on fund managers and market participants for things spiraling out of control?
Yeah, and I have a whole chapter on that in my book, and it's called The Alpha Trap. And I talk about robo-traders. Here we are on the floor of the New York Stock Exchange. Lots going on, lots of activity around it. But every expert and every investor knows that over 90% of the trading that goes on here is automated. It's fully computerized. But it's worse than that because passive investing, so it's sort of like, let's say one mosquito lands on the back of an elephant. Mosquito, gets a good meal, and the elephant doesn't even notice. But what if 1 billion mosquitoes land on the back of the elephant? The elephant dies. And that's what passive investing is. So when Jack Bogle invented it with Vanguard index funds, 30 years ago, whatever, it was a good idea. Fees were low, and you said, hey, I'm not going to try to beat the market. I'm just going to try to tag along. But because of the success of that, more and more funds are passive, ETFs, index funds, etc. And there are fewer and fewer people like you see here. These people actually commit capital and make two-way markets. But the old days when, if everybody wanted to sell, the specialists down here had to buy. If everybody wanted to buy, the specialists had to sell. You had to make a two-way market and sort of keep it in balance. That's gone. I mean, you can talk to people down here, they'll tell you that's long gone. So with so much passive indexing, what happens if there is a serious market crash, which I certainly expect, and we've seen many in the last 30 years, who's going to be the buyer? There are very few active investors left. So when people want to redeem, say, give me my money back, the passive guys have to sell. So they're selling. Who's buying? That's what the market makers used to do, but they don't exist anymore. So, and then, of course, we have robo allocations, 60% stocks, 10% cash, 20% bonds, whatever. This is all robotic. That's what these robo investors are. So people are being sucked into stocks. They're indexing. They're trying to hitch a free ride on the market, but the market itself is going away. So when the next crash comes, there's going to be no bottom because it's going to go no bid.
Well, one of my favorite parts of your book is when you were invited to speak at Morgan Stanley, but I'm not going to give too much away. Jim, will readers be shocked at how vulnerable the market is right now?
Yes, and the real insiders, now in the book I talk about, these are one-on-one private conversations, so not, like in an audience or whatever, but I had a long talk with Ben Bernanke when I was in Korea. I spoke to former Secretary of the Treasury Tim Geithner, had a long talk with an hour just one-on-one with John Lipsky. A lot of people don't know who John Lipsky is. John Lipsky was the first American to run the IMF. And Americans are not supposed to run the IMF. That goes back to 1944. But when Dominique Strauss-Kahn was arrested, got hauled off an Air France flight in 2011, they weren't ready with the successor. They didn't expect that to happen. So Lipsky stepped up as the acting director until they picked Christine Lagarde. So, an hour with the former head of the IMF. So what they tell you privately, they can't actually say publicly, but they understand the risks. And Bernanke and Lipsky both said to me, the international monetary system is incoherent. Now, it struck me because we were 9,000 miles apart and about a year apart, and they both used the same word. It wasn't rehearsed for my benefit. It told me that this is the lingo of the global monetary elites, the people who actually do run the system. They understand there's no anchor. We're gold standards long gone. You say, what's the dollar worth? Well, they'll quote euros, $1.12 to the euro, or 100 yen to the dollar, or 7 yuan to the dollar. Those are cross rates. I mean, I understand them. I understand foreign exchange. But those are cross rates. There's no anchor. There's no one thing that's not a currency that all the other currencies can be anchored to, which used to be gold. And by the way, Voz, as you know, next Tuesday is the 75th anniversary of bretton-woods. It was July 23rd, 1944, when they signed the agreement. And I'll actually be up at bretton-woods with a private group, Larry Summers will be there, and Ben Steele, the Council on Foreign Relations. My friend Stephanie Kelton, she's the big brain of modern monetary theory. We've got quite a group, and we're going to kind of try to recreate the bretton-woods atmosphere and talk about the future of the international monetary system.
Well, that's perfect timing because that's when your new book, Aftermath, debuts. And I just want to switch gears real quick. Jim, how did your experience in the CIA contribute to this book?
Well, I learned things in the CIA that I can just bring right to Wall Street. And one of them is, it gets a little geeky, but it's called Bayes' rule or Bayesian statistics. Now, what is Bayes' rule? It's a formula, but you use it to solve problems when you don't have all the information. I always say, if you had all the information you needed, a smart high school kid could solve the problem. But how do you solve life or death problems when you have little or no information? This is the problem we confronted after 9/11. My particular involvement had to do with, there was insider trading, options trading in advance of 9/11. The volume of United Airlines and American Airlines on the 2 days before 9/11 was 286 times the average daily volume. And I talked to one of the greatest market makers in history, John Mulheron, who sadly passed away. But John was a specialist. His firm was a specialist in America. He said it was the most blatant case of insider trading he had ever seen. I invited him down to CIA, and he kind of told that to our group. But so what the CIA said, they don't do criminal investigations. That's for the FBI and the SEC. But they say, well, if there's going to be another terrorist attack, will there be insider trading again? Can we spot it? Get a FISA warrant, break down the door, and stop the attack. That was what we call Project Prophecy. Well, in the course of doing that, I learned Bayes' rule, which I hadn't heard about but didn't really understand earlier. And again, we had one attack. See, Janet Yellen, she's what they call a frequentist statistician. She would have said, well, give me 100 attacks, and then I'll have a database, and I'll have some correlations and do regressions and figure out what the pattern is. Yeah, but you got 300,000 dead. So what we were trying to do was look for the next attack with very little information. Well, so I took that and began applying it in other fields, including predictive analytics, forecasting, and capital markets. So on June 20th, 2016, I was in a capsule on the London Eye. That's the big Ferris wheel in London on the South Shore of the Thames, looking at a camera, and I said, the UK is going to vote to leave the EU. To vote for Brexit. You should short sterling, buy gold, and that'll be the trade, to get through that. It's exactly what happened at a time, and the world was shocked. Everyone expected they would remain in the EU, and they didn't. For months I got, emails and stuff. Thanks for putting my kids through college, because that trade worked really well. A couple of months later, October 2016, early November 2016, I was going around the world on book tour for The Road to Ruin, and did interviews like the one we're having right now. And people say, well, Jim, you're an American. Pardon me. Who's going to win the election? I said, Donald Trump. I said, it'll be close. We'll be up late, but Donald Trump's going to win. And usually they would roll their eyes, laugh at me, their face would turn white or whatever. But of course, that's exactly what happened. Well, these were not wild guesses. They were using this technique I described, particularly Bayesian statistics. And what you do, and statisticians hate this, but you start with an assumption even though you don't have enough information. And if you have zero information, it's 50-50. So is the market going to go up or down today? Well, you start out, maybe you just say 50-50, don't really know. But then you update that for new information coming in. You can do this with elections, you can do this with the price of gold, you can do this with a lot of things. And as the information comes in, you say, what is the probability that the subsequent event would happen if my original assumption was true? And so if it's high, the conditional probability is high, you go back to the original assumption and you upgrade it a little bit. You say, well, it's not 50% anymore, it's 60%. And then you get more information, and again, look at the conditional probability. Well, maybe now it's 80%, or it can go the other way. It can fade, and then you say, well, that's wrong. But if you keep doing it, you can eventually get to 80, 90% probabilities, and then you can be very confident. But you're not guessing, you're not going with polls, you're not going with the conventional wisdom. It's a rigorous method. That's one of the things I learned at the CIA, brought it to Wall Street and geopolitics, and we're having a lot of success with it.
Well, give a CIA look to this. Russia and China have been on a gold buying binge. What are they up to?
Well, that's a great question. So in the last 10 years, Russia has more than tripled its gold reserves from 600 tons to about 2,300 tons. Chinese have done the same. They've gone from 600 tons to just about 2,000 tons. That we know of. There's a good chance they have more gold stashed away, but that's a separate subject. So why are they doing this? Are they stupid? Or are they seeing something that most people don't? Well, I spent a lot of time in Russia and China. They're not stupid. Chess is the national sport of Russia, and China has a 5,000. They're not stupid. So they see something coming, and there are two reasons to do this. In the case of China, they have $1.4 trillion in treasuries, so they can't dump them. If they did, the president could stop it with one phone call. They can buy fewer going forward. They can shorten up the maturity structure, so you just sit there and the treasury pays you and you're out without dumping. But in the short run, they can't dump them. But if you buy enough gold, there's your hedge. So if inflation comes along, your treasuries are worth less, but your gold is worth more, so you've hedged your position. Russia is in a different game. Russia is getting out of treasuries as fast as they can. More than 20% of their reserves are in gold. So the reserves today are about $400 billion, a little higher, so $100 billion worth of gold. Now, but there's something else going on, and Voz, this has to do with the reset or the reformation of the international monetary system. So right now, the U.S. has weaponized the dollar. We're throwing tariffs, sanctions, we'll freeze your account, seize your account, put on an oil embargo. Any bank that does business with Iran, forget about doing business in the U.S. And these tools are very powerful. We're fighting financial wars. When Iran shot down the drone, everyone was waiting for Trump to fire cruise missiles, and he didn't. And they said, well, that's good. We avoided a war. No, we're at war with Iran, but it's a financial war. Things are not blowing up, but things are happening. Their currency's devalued. Their inflation is up. Their economy is sinking. They're cut out of the payment system. They can't sell oil for hard currency. These are very powerful weapons. Now, so far so good. But the problem is, if you're the bully in the playground, you come in one day, you beat up a kid. You come in the next day, you beat up another kid, and so on. What happens? All the kids form a gang, and they beat up the bully. So what's going on in the world is that Russia, China, Iran, and others, they're tired of being the target of sanctions. So they're developing a cryptocurrency. It's what's called a permission. Forget Bitcoin. I'm not talking about Bitcoin. This is their own currency, maybe the Xi coin or the Putin coin. It will be on what's called a permissioned distributed ledger, permission blockchain. That means that you can only be in it if they invite you in. So it's like joining a club. You have to get through the membership committee to get in the club. And they'll form a trading network. And the cryptocurrency will be anchored to something convertible to gold, and they have physical gold. Now, the way it works would be, so now Iran can sell oil to China. China can sell infrastructure to Russia. Russia can sell natural gas to China. Everyone take a vacation in Turkey. These are your members: Iran, Turkey, Syria, North Korea, Venezuela, China, Russia. But maybe China could bring in Hong Kong, or maybe the BRICS invite Brazil, etc. So you've got this trading network. Everyone's using the cryptocurrency to keep score, and periodically you settle up in gold. What's missing from that system? The dollar. There are no dollars in it. So you don't need FedWire, you don't need SWIFT, you don't need any dollar accounts that the U.S. can freeze. So this is the pushback. It's coming. I've met with people at the Treasury and in the National Security Committee. You always get the meeting and they say, thank you, Jim, but I don't really think that's happening. And, well, you'll find out the hard way. This isn't speculation. This is happening. There's very good evidence for all of it.
And when you're talking about SWIFT, you're not referring to Taylor Swift. That's something completely different. Okay, so they want to use this new Putin coin to weaken the U.S. What will that incur? Are we going to lose a geopolitical grip? Are we going to be less secure as a country? Are we going to be a third world country? What's going to happen?
Well, great question. The answer is to most of that is yes. If our most powerful weapon are our financial tools, if you don't want to blow something up, but you can get regime change with financial warfare without firing a shot. That's an extremely powerful tool. Well, if you negate that, if you can no longer do that because they have an alternative system that actually works, now we've lost one of our most powerful weapons, number one. Number two, the system, it's not going to knock the dollar out of the box on day one, but it will begin to erode the reserve currency role of the dollar, and over time, that will lessen demand for treasuries. Interest rates will be higher. I met with a very senior guy at the Pentagon, and brilliant guy. He was the head of their long-range planning, something called the Office of Net Assessments. A geeky name, but they look 5-10 years into the future and the future of warfare. And his name was Andy Marshall. He retired recently. I said, he's 92. He'd been there since Nixon, so I call him Mr. Marshall. I said, Mr. Marshall, someday you're going to send a destroyer to Singapore to refuel, and they're going to pull up at the fuel dock, and the operator's going to say, fine, pay me in SDRs. And for the first time in 100 years, you're going to have an expensive forward deployed military that you have to pay for in a currency you don't print. And he got it. He might have been the old time, but he understood it better than people at the Treasury, unfortunately.
Well, that is freaky. But Jim, the premise of your book is that it's not going to be the end of the world. It's just going to be a little different. So how do we prepare for this?
Well, it's a very good point, Voz. It's people, when you're kind of out in the public square, you're writing books or giving interviews. People always want to put words in your mouth and say, Jim Rickards says it's the end of the world. Sell everything, buy gold. I've never said that. I don't believe that. I like a 10% allocation of gold, but the world could be different. History is not just a linear onward and upward progression. It can be for a period of time, but it's much more cyclical, ups and downs. That's what history teaches us. So imagine a world where, it's not Cormac McCarthy, it's not Mad Max, but maybe it looks like Grover's Corners, New Hampshire, 1902, out of Thornton Wilder's Our Town. A little more agrarian, a little more rural, a little more communitarian, where a lot of the big ticket critical infrastructure systems fail or just don't work anymore. There's various kinds of dysfunction. Well, that might be an extreme version, but that's one vision. There are others. I point to one of my favorite authors, Lionel Shriver, and her book, The Mandibles. That's a novel. But, when you're doing nonfiction forecasting, what's the difference between that and a novel? You're talking about something that hasn't happened yet, at least that Lionel does in her novel. But the point is, and she paints a picture a little bit what I'm describing. It looks more like Venezuela. So, there's supermarkets, but there's nothing on the shelves. They're police, but they only work if you pay them. Some people have jobs, but many people don't. The first jobs to go are a lot of elite jobs. You don't need university professors, but you might need somebody who does maintenance in some place, or a teacher or someone like that. So that's the picture she paints. She very kindly mentioned my book Currency Wars in the introduction to her book. So I kind of returned the favor a little bit and talk about her book. But it's one of several possible visions. But the point I make, and the bottom line, Voz, is that we're not helpless. There are things you can do today, and this is really the point of the book. There are things you can do today to prepare for these scenarios. You don't have to wait for them to happen. You don't have to be a victim, and they're not that extreme. Certainly some gold, a big cash allocation. Warren Buffett has over $120 billion in cash on the balance sheet of Berkshire Hathaway. Why does he have that much cash? He sees what I see, and he's ready to go shopping for bargains. If you're fully invested in stocks, let's say, and there's a crash, what do you do? You're calling your broker. You're pushing buttons. Sell, sell, sell. Well, everyone's trying to do the same thing. The price is collapsing. Your money is disappearing before your eyes. But if you have cash, you can take a deep breath, step back, and say, okay, are there any bargains here? But you can't do that if you don't have cash. So gold, cash, real assets, real estate, the house you live in, maybe another property, a farm is not a bad idea. And then natural resources, water, oil, and you have a slug of stocks. But people say to me, Jim, you have some gold. How do you sleep at night? I say, you're 90% in stocks. How do you sleep at night? I'd be scared to death if that was my portfolio. So some of it's just common sense, but I kind of lay it out for the reader.
Well, Jim, I can't let you go without asking for a prediction. Some people say Bitcoin will reach 1 million by 2020. Where do you see Bitcoin?
I see Bitcoin going to $200 as a residual for criminals. And by the way, I did an interview in December 2017. And at the time, Bitcoin was going up about $1,000 a week, or actually more. It was like $1,000 a day. It was $8,000, $9,000, $10,000. And the reporter said, give a forecast. And I said, well, it could go to $20,000. That wouldn't surprise me. This is a bubble. Bubbles go as high as they go. You never know when they're going to break, but you do know that they will break. I said Bitcoin could go to 20,000, or even higher, but then it'll crack and it'll be one of the greatest crashes of all time. And that's exactly what happened. It ticked 20,000, and then it went down to, I think, 3,000 or 4,000. It was like an 80% decline. Now, I know it's going back up a little bit, but this is just it's a pump and dump thing. The amount of manipulation of Bitcoin is not to be believed by the miners, by the exchanges, by various parties. Let's say, I sell you Bitcoin for 10,000, you sell it back to me for 11,000. I sell it to you for 12. You sell it to me for 13. It's called painting the tape. They used to do it down here, but it's been illegal since 1934. But that kind of price manipulation, there's no volume. There's no transparency. We just sell it back and forth to each other to get the ticker to go up to bring in the suckers. That's how Bitcoin works.
Well, Jim, I have to say, even for those who don't necessarily see eye to eye with some of your views, I think they will still enjoy your book. It's really entertaining, it's intellectually stimulating, and it's available July 23rd. But if you can't wait, it's on pre-sale, correct?
It's on pre-sale, available from Amazon, Barnes & Noble, and other online sellers.
Awesome. Thank you so much for paying us a visit on Modern Wall Street. Thank you. See you soon.
Thanks, Faust.